Hello there. So this video was requested. I got requested that I review Verizon Communications and AT&T. So this is that video. It was a request and a comment from one of my previous videos. If you'd like me to review any particular stock or share, if you'd like me to do a comparison between two, please do feel free to leave me a comment down below and I'll be happy to do that. But this video is about Verizon Communications and AT&T. I'll be comparing both of the companies, what they do, how much profit they make. We'll be looking at the balance sheets, and I'll be looking at the analyst forecast for both of those companies. I will also be giving you my view on what I think they'll be doing. I'll be letting you know whether I would be investing in either of them and which one I think is best. And we'll go through the points like I did before, where I literally compare key metrics on each company, and that's what we do. If you're new to this channel, welcome. My name's Andy, and on this channel, I'd like to talk about money and success. If you're interested in either of those two topics, please do hit that subscribe button down below, hit the notification bell, and if you enjoyed this kind of content, remember to give it a thumbs up because it helps the YouTube algorithm, which in turn helps me, so I appreciate that. That's great. I need to do a little quick disclaimer here whilst I'm reviewing these shares and I'm going through the results of my own research. I am not a financial advisor. This is not financial advice. You need to make your own decision whether you're going to buy or sell any shares at all. You're responsible for you. That's that said. Shall we dive right in? Here we go. So we'll start by looking at AT&T. So what do AT&T do? Well, AT&T do a number of things. They're essentially three businesses in one. It's a mobile phone company, an entertainment company, and a media company, all rolled into one. They've recently had a new CEO start on the 1st of July. John Stankey became the new CEO. This slide that we're looking at now is straight from their latest investor presentation. As you can see, they've got the 5G network, which they're rolling out. They've got HBO Max has been launched, which now has a number of subscribers. We'll go into more detail about that later. And they have growth strategies in place for various areas of their company. And one key thing I want to point out is they're still committed to supporting the dividend, their 36-year record. This is a dividend aristocrat. So this is a company that really is proud of that. And they've so much so they've put that in their investor presentation. This just gives you a little overview of the different aspects of the business. So as you can see, they've got the wireless business, they've got the entertainment group, they've got the business wireline, business. You can see that everything has pretty much been falling a little bit in this most recent year. And this again shows you some of their other markets, or segments if you like. So they've got Warner Media, they've got Latin America. And then this is just a little bit about their new, latest, greatest product, HBO Max. And between HBO and HBO Max, they've got around 36 million subscribers, which is obviously key. And did you know these guys brought you things such as Game of Thrones and Crazy Rich Asians? How's that, you see? So there's some big brand names in here. And that's all owned by AT&T. Who'd have thought it? Anyone would have thought it's just a telephone company, but no, does all kinds of things. Let's have a little look about Verizon. So what do Verizon do? Well, Verizon is a network company. Everything they do when you look at their website is talking about being superior, good customer service and whatnot. This is Verizon's website. I notice on here, they're even launching a credit card in association with Visa, obviously. But if you look here, what they do, 5G, 4G, broadband and fibre, media technology. So on the face of it, they seem very similar, but the medium technology is where they're different. Rather than having HBO and brands like that, these guys actually own Yahoo, Huff Post, and TechCrunch. That's their media group. So it's a completely different media group to AT&T. So on the first metric of business risk, I'm going to give this a draw. They're both varied. They've both got fingers in lots of pies. They're both basically communications companies. In many respects, they do the same kinds of things in their, what you would have thought was their core business back in the day. Yet now, you know, AT&T isn't AT&T like it was back in your grandma's day. It has evolved since then. Even though over the past 36 years it has kept paying the dividends, the way it's making its money is changing. Landlines are being used less and less, yet fibre lines are becoming more and more important. 5G networks are becoming more important. And both of these companies have exposure to those markets. So They are, in many respects, I would say, even on the risk side of things. I wouldn't like to say one's a more risky business than the other, and that's why I've scored this 1-all. So next, let's take a little look at the charts. So AT&T, as you can see here, it's 52-week range. Its range is from a high of $39.70 down to a low of $26.08, and it currently is priced at $29.57. So it's slightly closer to the low side. It's actually 25.52% down from its 52-week high. Its earnings per share, as we can see there, is about 50 something percent, maybe 60% higher than its dividend rate. And look at its dividend yield. Its dividend yield 7.03%. That is a good dividend, especially when you remember these guys have been growing this consecutively for the past 36 years. So there's a good chance they're intending to continue that for as long as they possibly can. And if they do, I mean, it's a great dividend yield. That 7% dividend. There's not many places you get a dividend that good that's been going for so long. Let's now look at Verizon. 52-week high is $62.22. Their 52-week low is $48.84. So quite a tighter range, I would say. They've not dipped as much, which is interesting. So they've been more stable. And they're currently $56.85. So they're only actually down at the moment 8.63% from their 52-week high. So there's not as much headroom for them. You know, if they go back to their 52-week high, they've not got as far to go up as AT&T do. But then on the other hand, you could say, well, that maybe means they're more safe. Their earning per share there is $4.76, whilst the dividend rate is $2.46. So that's good. That's almost double. So that's great. Dividend yield is a lot lower on this one at 4.33%. The PE ratio is 11.94, which is good. That's low. Let's have a look what PE ratio was on AT&T. With AT&T, the PE ratio was 9.26, so it was lower. So AT&T, on the face of it, it seems it would be better value. So let's have a look at the summary there. So in summary there, we're going to give that round really to AT&T across the board. It's got a lower PE ratio, which basically means it's better value if you're looking at that as a value metric on its own. Bear in mind, you shouldn't just look at one value metric. At the end of this video, I will be going through a whole host of value metrics, and I'll also be going through my profit analysis as well. And that actually paints a little bit of a different picture. So stick around for that near the end. You'll see what I mean by that. The dividend yield, clearly the 7% dividend yield from AT&T is a lot better than the 4.33% dividend yield from Verizon. So if you're looking for the yield, then AT&T is a clear winner on that metric. So that's why that got that point. And for the share price value, again, I've given it to AT&T because it's 25% off its 52-week high. So therefore, in my view, it's got that headroom to go back up to, whereas Verizon's only 8% down, basically. So it hasn't got as much room to go back up. I mean, that's not to say it can't. It can go past its 52-week high. There's nothing to stop it. But for this metric, I'm working on the basis that they're operating in a range, and if that's the high and that's the low, what's the range, where you're buying it at? And that's how I'm scoring that to give that to AT&T. Let's carry on. So here is the income statement for AT&T. What we're looking at here is a total revenue, and I can see that generally it's been increasing, but it has dropped in the trailing 12 months. But prior to that, since 2017, it's been climbing. It had a drop down from 2015 to 2016, as you can see there, and another little drop from 2016 to 2017 before turning around and coming back up again. The next thing I'd like to look at there is the gross profit and the operating income. So let's look at the gross profit first. The gross profit, it's gone up a bit, down a bit, then it's gone up, and then it's just dropped a touch, just a little bit in the trailing 12 months. Its operating income, it's kind of been stable, really, to be honest with you. It was higher in 2018, then dropped down a little bit in 2019, and it's gone down again in the most recent trailing 12 months. So let's look at the net income. Where's that? Net income. So its net income, it was 13,000, then 12. Then it jumped up a lot. Look at 2017, that was a good year. Then it dropped down again. down again and down again. So that's the income statement for AT&T. Let's now look at the income statement for Verizon, see how that compares. So Verizon's revenues, again, it dropped to 2016. 2016 was obviously not a good year in this industry. Went up in 2017, up again in 2018, up again in 2019, and again dropped again in the trailing 12 months. And then the gross profit paints very much the same kind of pattern. The operating income, again, it's pretty stable. A small drop in the latest trailing 12 months. And if we get to that net income, so the net income, 17,000, 13,000 in 2016, then it went up. Bear in mind when I say this is in millions, by the way. They're only making 13,000, they'll have a real problem. The 2017 was a good year for them as well. So something interesting obviously happened in 2017 for both of these companies. 2018 it dropped, 2019 it went up again, and then just a small drop in the current trailing 12 months compared to the previous year. And net income, bear in mind, net income is essentially the profit of the company. It's like the bottom line. So that was only a small drop, whereas I think AT&T was a bigger drop on the net income. Yeah, it was. So I'm going to give that one to Verizon. So there you go on the income statement. Both are pretty flat, in all honesty. There's nothing particularly interesting going on there. There was that year where we had the big bump, but that happened for both of them. So something amazing happened in the industry in that year. I don't know what, I'll be quite honest with you. I have to research a lot deeper to find out. But something obviously happened in the industry that was good for both Verizon and AT&T. Both of them have fallen slightly in the current trailing 12 months, which is to be expected. But Verizon fell the smallest on its net income. So I'm going to give that one to Verizon for that reason, because its income, its profit, if you like, has been more robust in the current economic climate. How's that? Right. Let's have a little look at our dividend safety. So for this, what we're looking at, I like to compare the revenue per share to the dividend per share. And I have a little look to see how the revenue per share is growing. Is it going up, going down, staying stable? In fairness, looking at this, it's relatively stable. It's between that $24 to $26.50 per share value. It's currently at $24 per share. And if we look at the free cash flow per share, which is that bottom line there, we can see that in 2015 it was $2.82 per share versus a dividend being paid out of $1.89 per share. In 2016, you can see it was $2.60 per share versus a dividend of $1.93 per share. In 2017, you can see it was $2.67 per share versus a dividend of $1.97 per share. And you can basically see it's increasing. If you look at the next year, it's gone up again. In 2019, it goes up again. And it's just in this trailing 12 months where it's dipped just a little bit on the free cash flow per share. But the dividend, despite that, has still gone up, albeit only a little bit. The dividend has consistently gone up every year, and there's plenty of headroom in that free cash flow to cover that dividend. So let's have a look now at Verizon. So same metrics on Verizon are here displayed on the screen. So their revenue per share, again, it's a little bit lower now than it was, but it's basically in a range. It's between $32 per share and just over $30, $30.86 per share. So it's in quite a tight range as well. It's currently standing at $31.35 per share. But if we look at the dividend, we can see the dividend has been increasing. I don't know why it's dashed out for the current period. We'll have to look into that and see if it's been suspended, but I would be very surprised if they suspended it, seeing as their free cash flow there, if we look at that, it dipped from 2015 to 2016, but since then it's been increasing continually, and that's $5.11 of free cash flow. So it's gone up quite nicely there. So I'd be expecting the current 12-month dividends to be at least the same or higher than the previous year. I'm going to give the dividend safety 1 all. I will come back and edit this point. If it turns out that they've paused their dividend, I will be looking into that when I finish filming. But no, we're going to give the dividend safety 1 all. They both have the ability to pay the dividends as far as I can see. I like to look at the assets versus the liabilities. Now, I've only really done this with REITs before for you, and when I've been doing it with REITs, I look at the total assets and liabilities. When I'm looking at regular shares like this and companies that aren't REITs, I also like to look at the current liabilities. So I'll run you through that now. Okay, so now let's have a look at the assets and liabilities. Previously, when I've done this, I've been looking at REITs, so I've not been looking at the current assets and liabilities, but with this, I will be looking at that as well. So let's have a little look here. So you can see on the screen now the total assets for AT&T, ticker symbol T, versus its liabilities, its total liabilities. You can see it's got a ratio of 1.55, and you can see Verizon has a ratio of 1.28. Now, so you know, the higher that number, the better. 1 is considered good because it means the company's got enough assets to cover all of its liabilities. So you really are looking for a number above 1 there. That's important. If it was lower than 1, that would be a little red flag. If it's above 2, that's excellent. So both of these are considered good. AT&T is obviously slightly better than Verizon because it's got more assets in relation to its liabilities than Verizon does, hence the bigger number there. So that's what that means. The current assets to the current liabilities. So these are the liabilities that are falling due within the next 12 months, and the current assets are obviously the assets that are coming in within the next 12 months. So it's cash on hand or things that could be easily liquidated to cover the current liabilities that are due in the next 12 months. And so again, we're looking for a higher number being better. So in this instance, Verizon wins with 0.93, whereas AT&T has a current asset to liabilities ratio of 0.81. The last metric I've put on this sheet is also quite a telling one. So this is the free cash flow to liabilities. So what that number shows you there is how many years it would take the company to pay off all of its liabilities using its current cash flow. So as you can see, AT&T could pay it off in 8.87 years, whereas Verizon would take 12.47 years to pay all of their liabilities off with their current cash flow. So that would indicate that AT&T are better on that particular metric. Bear in mind, as I said before, you don't want to overlook at just one metric, but on that metric, that's a win to AT&T. So in summary, assets versus liabilities, AT&T had more coverage than Verizon did, so we've given that point to AT&T. With it comes to current assets versus current liabilities, both were below 1, which I was a little bit disappointed with, but it's still not too bad. They're both okay in that respect, I would say, but Verizon was stronger than AT&T because it was closer to 1. And with free cash flow to liabilities, AT&T gets that point there because AT&T could pay its liabilities off faster than Verizon could using its current free cash flow. So now let's take a little look at the balance sheets of each company. We'll start with AT&T. So this is AT&T's balance sheet. We're going to have a little look at the cash situation. So total cash has improved. In the last report, they had more cash on hand than they had in December 2019, which was also considerably more than in 2018. They had a lot in 2017, but if you remember when we looked at their income statement, they had that bumpy year as well, didn't they? So that makes sense. It's good that they freed up some cash. Total current assets, so it was 35 in 2015. It went up in 2016, up a lot in 2017, down a little in 2018, up in 2019, and up again in the most recent report. So that's fantastic. Total assets, I'm really looking for a climbing trend here is what we're hoping for. And what are we getting? So it's gone up between 2015 and 2016, up again in 2017, up again in 2018, up again in 2019. And in the latest report, there was a slight dip there. So that's the only thing we notice on that. Total liabilities, they're climbing, but by a comparable rate. So that's absolutely fine. So the total equity has been increasing, apart from the latest period where it's gone down a little bit. So that's under the stockholder equity there. Okay, let's now look at Verizon's. This is Verizon's balance sheet. So the cash, their cash has stayed very similar. They've not had a big spike as such, which is interesting because they did have that bumpy year as well. but they have increased the cash they've got available now, not to the same levels as AT&T, I noticed, but they have improved the cash they've got on hand. Their total current assets have increased between 2015 and 2016, again 2016 to 2017, and again 2017 to 2018. In fact, they've increased consecutively. Every year's increased, so that's great on the total current assets. Let's now look at the total assets. Again, I see them increasing year on year, which is fabulous. That's what we wanted to see. Their total liabilities, in fairness, are also increasing, but nothing to worry about. That's in line with. So let's have a look at the stock equity, the total equity there, and that has been increasing as well with no dips. So the balance sheet, I'm going to give that one to Verizon. I wouldn't say there's anything particularly wrong with either balance sheet, but I would say Verizon's balance sheet just looks that little bit stronger. It didn't have any of the dips in the current period that AT&T are currently experiencing. So that's really the reason that I'm giving that point to Verizon. Let's move on. So now let's look at the dividend situation. So the dividend scorecard here. So AT&T has 7.03% dividend yield. They've got a payout ratio of 65.18%, and their 5-year growth rate is 2.09%. So not a great deal of growth there, but it is an exceptionally high dividend in the first instance. So it doesn't really need to grow much to still be a high dividend, but it has grown consecutively for the past 36 years, which is an impressive thing. If we click on dividend history here, isn't that a beautiful thing? So you can see there the dividends have literally every year grown and grown. If you're getting dividends back in 1995, they were 19 cents, whereas the most recent dividend was 52 cents. So over doubled in that time period. But this isn't even the full picture. They've been giving dividends and increasing the dividends even longer than is shown on this website here. So that is fab. Let's now look at the dividend scorecard for Verizon. So it's got a 4.33% dividend yield, 51.68% payout ratio, so a little bit lower payout ratio, so that's good. Slightly more growth, not a lot though, 2.51%, it's not exactly breaking any world records, and 13 years of consecutive dividend growth. I notice here they have declared a dividend, and that dividend is 61 cents, 61.5 cents. I'm just going to do a quick piece of maths here because these are paid quarterly. So yeah, that will arrive at the $2.46 payout. So if you remember that thing where we had the little dash earlier when I was comparing that, this I think clears that up. They have declared, so they are going to be paying a dividend, so we're good. Now let's look at the dividend history. So here's the dividend history for Verizon Communications. As you can see, it's a pretty picture. It's been increasing year on year, and it's done that for 13 years, which is obviously fab. It was flat before that, look. So it was flat around that period then, and then started increasing, whereas AT&T was continually increasing. So let's go to the scoreboard. So for growth rate, we're going to give it to Verizon. It's only slightly higher, 2.51% versus 2.09%. So neither of them are breaking any world records in growth there for their dividends. But Verizon was slightly higher, so we'll give that to Verizon. And for dividend growth years, the number of years have been growing the dividend, it's the clear winner, AT&T. It even mentioned it in its investor presentation. It is a dividend aristocrat. It's been increasing that dividend year on year for the past 36 years. I can't see any reason for that to change at the moment. That's certainly something they have no intention of changing, it looks like to me, even though it might only be a small increase. But bear in mind, it is a 7% yield at the moment. So we have to give that one to AT&T. Let's look at the analyst's forecast next. So this is the analyst's forecast for AT&T. As you can see, there's 11 analysts offering their opinions for the 12-month target. You've got the high of 38, the average of 35.9, and the low of 32. So that's what the analysts are predicting for the 12-month price target of AT&T, which is currently $29.57. This is the analysts' forecast. Again, 11 analysts, but for Verizon this time. This time they've got a high of $70, an average of $61.09, and a low of $57. Its current share price is $56.85, as you can see at the top there. So it's got an upside of 7.46% represented if you go to the average, where versus an upside of 21.41% for AT&T. The analysts have both of these as a moderate buy at the moment. So on the analyst forecasts, we have to give that one to AT&T because clearly the upside is a lot higher on AT&T. They're showing it as 21.41% upside versus 7.46% upside. So clearly there's more gain to be had if you would buy AT&T than Verizon, if the analysts are right, that is. Let's add up the score here. So the score comes in at AT&T 9 and Verizon 6. So we have a fairly clear winner there. AT&T wins on these metrics. Now I am going to go through my value analysis. I'm going to go through my profit analysis, which actually shows a pretty different picture, if I'm honest with you. And then I'm going to go through my own price forecast and what I believe the shares are going to do in the future. So I'll go through that with you now. Here we go. So on the value analysis, you can see the 52-week high to 52-week low and the percentage fall from its high. So its current share price to its high, as we discussed already, AT&T is 25.52% off its high, whereas Verizon is 8.63% off its high. That's one of the things I like to look at, because if you think things trade within a range, if you buy on the dips, you want to buy when that's a bigger number. Well, 25% is clearly a bigger number than 8%, isn't it? The PE ratio, again, from a value metric point of view, you want that to be low. I know we've looked at that already, but you can see them side by side here. AT&T's is lower. Not that 11's high, to be fair. I wouldn't say that's bad value. I'd say that's good value for many things. You can see the assets and liabilities, the number of shares, and then the value metric that's calculated there is the intrinsic value, or the net asset value. That's what NAV stands for. So the net asset value of AT&T is $27.13 per share, and it's currently standing at $29.57 per share. So it's trading slightly high of its net asset value. And in comparison, Verizon, its net asset value is $15.49 per share, and it's currently trading at $56.85 per share. So it's trading well above its net asset value at the moment, which would tell you out of the two companies, AT&T again looks like better value from that metric. And book value, very similar thing. Book value per share, AT&T's 24.69, which you can see it's trading a lot closer to that than Verizon, where its book value is $15.15 per share versus a current share price of $56.85. So it's like 3 times its book value it's trading at the moment. Unleveraged cash flow, that's really so we can see the calculations lower down, which is the free cash flow to liabilities, which just shows you that AT&T could pay off its liabilities in 8.87 years using its unleveraged free cash flow, versus Verizon, which would take 12.47 years, so a much longer period of time, almost 50% as long. So again, that would indicate that AT&T is a better value. Total assets versus liabilities, again, AT&T is a clear winner there with a bigger number of 1.55 versus Verizon's 1.28. Let's have a look at the profit analysis, though, because this is where your picture changes. So on the profit analysis, you'll see the net margin is 14.76% for Verizon versus only 6.84% for AT&T. So Verizon's a lot more efficient in that respect. Its operating margin is also much higher at 23.05% versus AT&T's 15.11%. Its return on assets is higher at 6.49% versus 3.02%, and its return on equity is ridiculously higher at 32.25% versus only 6.8%. So certainly Verizon is sweating its equity a lot harder and has better profit margins, which is very interesting when you think the market cap of Verizon is currently bigger than the market cap of AT&T. Not a lot, but a little bit. So that's interesting that it's more profitable. See, these metrics might indicate this maybe is more of a growth company. So it will be interesting to see what these shares do in the future, which is what I'm about to forecast for you in my own predictions now. Here we go. So my best guesses, and that's all these are really, folks. These are just my best guesses. Please don't put any weight on these at all. The current share price of AT&T $29. This is a little game I like to play with myself. So you'll notice a number of shares. I basically pick a number of shares that makes it look like a value of about $1,000 purchase, so that I can then forecast what that value would be in 1, 2, 3, 4, and 5 years. Because if I do this and I compare it against different shares that I'm considering, this is exactly what I do when I'm comparing shares. I literally have a big spreadsheet with loads of them on it, and I go along and I decide which ones I think are going to do me the best, both on capital gain, and I also even factor in the dividend as well, depending on what I'm looking for. So you can see here these two side by side. Quite clearly, my opinion is that we would make more money buying AT&T than Verizon just on the capital gain, and that's before we factor in the big dividend of AT&T. Now, of course, I could be completely wrong. Without a crystal ball, who really knows? But based on where it's gone before and the trading ranges of both of these stocks, this is my best guess forecast, but it is just that best guess. I wouldn't claim to be particularly sure on it. On the right hand side there, where you see the percentages 5%, 5.5%, 6%, and so on, that's showing you what the share price would have to be in order to get that percent dividend yield. So obviously with AT&T, the share price is already $29.57. So you're already getting more than a 7% yield. To get a comparable dividend yield with Verizon, you'd need their share price to go down to $35.14. That's to get a 7% dividend yield, whereas it's currently trading at $56.85. Just for it to give a 5% dividend yield, it would have to drop down to $49.20. So if you're someone who wants a 5% dividend yield, then you would have to wait for Verizon to drop its share price would have to drop to $49.20 or less, or they would have to increase the dividend, which it doesn't look like they're doing at the moment, but they probably will do going forwards. So that's my review, that's my analysis, that's my breakdown. I hope you found that useful. If you did, remember, give me a thumbs up. And other than that, all it leaves me to say is thanks for watching and bye-bye.